Although there are many other channels on this platform that discuss dividend growth companies, there aren't many people who choose to concentrate on income investing or a combination of dividend growth and income. People were really interested in learning more about this method of investing, since it satisfied a need investors were looking for to make money. Undoubtedly, one set of people is nearing or in retirement, and they are searching for investments with greater yields that don't place as much of an emphasis on growth at this time, especially given how volatile the stock market is at the moment. You are not keen in pursuing growth or other high-risk holdings. Your interest in high-yielding stocks and ETFs is driven by holdings that can provide you with the highest passive income at the level of risk you are willing to take. But I believe there is a sizable group of regular dividend investors who are particularly interested in this style of valuing income stocks and funds over dividend growth holdings. As a dividend investor, you may hold shares of companies like Johnson & Johnson, Coca-Cola, and McDonald's, in addition to covered call exchange traded funds, ETFs like Guild or Riled, business development companies like Ares Capital, or exchange traded notes or ETNs like USOI to raise the total dividend yield on your portfolio. I really enjoy concentrating on investments that place a higher yield over growth. I prefer to invest in stocks with high dividend yields rather than those with lower yields, 1 or 2%, but higher share price growth. I don't invest all of my money in income stocks. I also have some higher yielding growth equities like Oaktree Specialty Lending Corporation and Realty Income Main Street Capital. But income is undoubtedly my favorite sort of investment in the stock market. So if you're not yet retired, you might be asking what on earth makes choosing income over growth so alluring. I wanted to discuss why I personally enjoy investing in the technique that I do in today's video. Remember that my intention in making this video was never to try to persuade you that my approach to investing is the best. That was never the idea. I have never said that this approach of investing is the greatest, because I am aware that it has drawbacks that deter some investors. I invest most of my money in non-retirement accounts, and mostly in high dividend paying stocks that are frequently non-qualified. As you might expect, those who detest paying taxes dislike my approach to investing. However, investing in high-yielding stocks and ETFs in non-retirement accounts frequently earns me a lot of criticism from people who are tax-averse. I also don't hate the more traditional dividend growth investing. Taxes aren't an issue if you invest in a tax-advantaged retirement account, like a Roth IRA. I have no problem with folks who invest in index funds or even equities for growth. I'm also not against those who invest for growth today and then transfer their holdings when they approach retirement in 20 or 30 years. These are all sound investment strategies, and as I've previously said, I also use index funds in a few of my accounts. Yet for me, the most inspiring method of investing is primarily through income investing, followed by dividend growth. So today I'm going to share 3 reasons why I prefer to invest in this manner. I also want to entice individuals who may not have previously thought about using a more income-oriented approach to investing by saying that it might be much more addictive than using only index funds or dividend growth investments. It certainly was for me, and the primary factor in my preference for income investing is my love of investments that provide a lot of cash flow. I've found that investing in and saving more money for things that consistently bring in large sums of cash flow on a quarterly basis, or better yet, a monthly basis, really motivates me. I enjoy viewing the numerous lines of dividend deposits into my account and the transaction history of my brokerage account. I appreciate seeing how all of my investments consistently send me income deposits. I discovered that receiving dividend payments into my account, rather than just keeping track of my stock's share prices, gives me a far greater satisfaction. In a sense, I discovered that when I only care about a stock's or an ETF's share price, as with a growth stock that doesn't pay dividends, I tend to monitor it constantly. And whenever we're in a bear market like we are right now, I'd find myself second-guessing my investments. I can remember focusing more on growth investing than income investing throughout my early to mid-20s. I would read a newspaper or a magazine, spot a stock that I felt looked promising, conduct some additional research, and then make my own investment decision. However, if the share price continued to decline for more than a few months, I would struggle with buyer's remorse. Yet, this is what really got me interested in income investment. Many higher-yielding investments, such as closed-end funds and business development organizations, have a share price that essentially stagnates over time. They do vary in height more than others. Yet, generally speaking, the share price of many better-earning investments doesn't fluctuate significantly. They instead provide dividend yields of 8, 10, or even higher. I don't really care when the share price of these kinds of securities gradually declines over time, because I'm more concerned with the dividends. A dividend reduction, in my opinion, is considerably worse than a 10% drop in share price. In fact, if it does decrease and the fundamentals appear strong, I will be able to purchase more shares for less money and increase my dividend yield. I also like real estate investing for this reason, especially with rental houses. As a result, I suppose I kind of want to invest in equities and ETFs that essentially perform similarly. With these big dividend payouts, I just feel more drawn to income investment. Let me know in the comments if you have any other questions about investing. Let's return to the video. The second reason I adore income investing is that if you can amass a sizable enough portfolio, you might never have to sell any of the shares of a holding you have. Your monthly or quarterly dividend payments may be sufficient to pay all of your living expenditures. Let's look at a typical illustration. Let's imagine you decide to retire and live off your stock portfolio on January 1st of this year, when you are 65 years old. Let's say for the purpose of simplicity that your entire portfolio is held in the Vanguard SP 500 ETF. You currently own 2,277 shares of VO at a cost of $439.25 a share as of January 1. This results in a portfolio worth overall of just over $1 million. You may have higher than average costs because of health difficulties, or perhaps you just like living in a more costly place, but you anticipate having monthly expenses of $3,000 anyway. In order to be able to transfer $3,000 into your bank account to pay for your expenditures, you decide to sell shares of VO every single month. Therefore, in order to pay your monthly costs starting in January, you must sell 6.83 shares of VO. However, you must sell 7.21 shares of VO on February 1st in place of 6.83 shares. This is due to the fact that the S&P 500 has resumed its downward path today, and as we are all aware, we are currently in a bear market. As of March 1st, you will need to sell 7.59 shares of this S&P 500 index fund because the price of VO has fallen further 5. Fast forward to July of this year, and you now need to sell 8.57 shares to pay your bills. Who knows how much further the stock market will decline in the coming months. But as it keeps falling, you can see the issue we have. In order to pay your bills, you have to sell an increasing number of shares from your portfolio. This can have a particularly negative effect on your retirement savings because it consumes more and more of your money. If you don't have enough money saved up, it may even shorten your retirement. How many times did you hear during the dot-com bubble and the 2008 financial crisis that people had to leave retirement and enter the workforce because their retirement savings had suffered significantly. Now, it goes without saying that you'll cut back on spending if the recession lasts for a very long time and stock prices don't rise considerably. The majority of people would be wise enough to avoid spending all of their retirement funds. What if, however, you were able to live off of your investments without ever having to sell any stock? What if you could create a dividend or income portfolio that pays you every month or quarter without you ever having to worry about share price swings when the market is down and everything's share price is falling? Imagine not caring at all if the share price of your investments drops by even 10% or 20%, because all you care about are the dividends and not the share price. Immediately, you'd feel a great deal less anxious when the stock market is shaky. If we experience a severe recession, dividends may be reduced, but having a well-diversified portfolio with a variety of investments, such as REIT BDCs, closed-end funds, covered call funds, and other types, will help you weather storms like the one we're presently experiencing. Additionally, it's crucial to allocate at least a portion of your portfolio to growth, as this will combat inflation. The thought of never having to sell shares of your holdings to support your retirement is another aspect of income investing that I just find immensely tempting. A holding like SCHD can assist in ensuring that your portfolio grows even if you are not reinvesting your dividends. If you don't happen to have an absurd amount of money invested, you won't be able to afford that level of luxury from a regular S&P 500 index fund. If you don't sell shares during retirement, it can be simpler to transfer your investments to a loved one, which can assist in preserving your fortune. Thirdly, it's simpler to predict when you'll be able to transition from earning a job to living off dividends. Therefore, I like prioritizing income above growth. Whenever money becomes your principal goal, as opposed to amassing a stake in a number of non-dividend paying stocks and ETFs, you may obtain a much better picture of how near you are to retirement. Let's imagine you've calculated that you'll need $3,000 per month in dividends in order to stop working a full-time job after budgeting and taking taxes into account. It might be more or less, but we'll keep this example straightforward. To find out how close you are to quitting your work, all you need to do is enter into your brokerage account, view your transaction history, and see how much dividend income you now receive each month. Let's imagine you notice that you currently earn $1,000 per month when you look at your transaction history of all the dividends from your growth stocks and high-paying companies. You are immediately aware that you have traveled a third of the distance. Contrast that with the conventional method of retirement savings. You can ascertain if you have $920,000 in a brokerage account right now, if that amount will be sufficient to support you in retirement. What if, like the market this year, the market crashes and the value of your portfolio falls by 20%? I'm aware that figuring out how much money you'll need for retirement is not particularly difficult, but this approach to investing makes it less obvious when retirement will be possible. I'm the type of person that prefers to have a certain objective. In my opinion, having a clear objective in mind makes it a lot easier and more inspiring to pursue. For example, earning $3,000 or $4,000 a month in dividends is a clear goal, and it's simple to see how far away you are from it. Since it was tougher to predict how much money will be in an index fund in the future, I was less driven to invest back then. However, when I buy stocks like Pennant Park, I can immediately see that I can afford 53 shares of it this week. At the present dividend rate, 53 shares will pay me $5.03 in dividends each month, bringing me one step closer to my monthly target. This simply feels more motivating to me than investing $500 in an index fund, which is something I still do. In addition, I enjoy watching those dividends grow incrementally each month. It purchases more shares, bringing me one step closer to achieving my goal. These are just a few of the reasons I like income investing, while there are many more. Once more, I'm not trying to disparage other investing strategies or persuade you that my approach is the best. I fully anticipate that some of the investments in my portfolio will perform worse than the market, and I am quite fine with that. However, if you are interested in receiving greater payouts, there is nothing wrong with following a more income-oriented approach to investing. Using the investing plan that works best for you is what matters most. And with that, this video will come to an end. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.